The banking sector acts as the primary intermediaries, the largest conduit for mobilization of domestic savings, and the main source of external capital to firms and key players in the payment system. Therefore, an efficient banking system, rules and regulation is necessary to enhance sustainability and growth of economies. Moving on the issues, inefficiencies of the bank can exist when there is a competition between the foreign bank and domestic bank as well as non-performing loans. The competition between the bank can give rise to the competitive pressures and test whether domestic bank can adapt and operate efficiently in the new environment or not. The bank need to incur additional managerial effort to handle non-performing loans and would result in additional expense. Besides, this situation will incur non-value-added activities to deal and supervise the collection process. Non-performing loans will signal banks use fewer resources than usual in their credit evaluation loan monitoring process. This shows that banks did not appropriately manage their credit risk. That is why the adoption of IFRS is needed to ensure proper accounting standards are used to deal with the transaction.
How does the issues happen? Issue 1. Banking firm is inefficient when there is a less cost efficiency due to high number of NPL. Bad debt losses increase and most resources are being used for the process of collecting NPL. Loan that bank lends to borrowers are the bank's asset. So, NPL causes inadequate quality of the bank's asset. Also, NPL causes bank to increase operating costs on non-value-added activities to collect the NPL. Therefore, it shows that banks have less efficiency that indicates more spending than earning. Second issue, NPL may arise when loans given by the bank to borrower and borrower are at risk of not being fully repaid the loan and interest. Some NPL cases may occur due to the external events like adverse economy, where the affected borrowers file bankruptcy that causes them unable to repay the loan. Another main cause of NPL is due to bad management, with lack of credit evaluation skills and not efficient in managing loan portfolio. In result, borrowers' credit applications are easily to be approved, and NPL increases when there is a lot of borrowers that are unable to repay the loan.
IFRS 9 can solve the issue of non-performing loan. We first look at the mechanism of IFRS 9. IFRS 9 requires a more granular assessment of credit risk in comparison to IAS 39. Under IFRS 9, banks now must place financial instruments into 3 distinct stages, including performing, stage 1, stage 2 underperforming, and stage 3 non-performing, rather than the unimpaired and impaired categories under IAS 39. As soon as a credit is originated, banks are required to recognize provisions based on 12-month expected losses, which is stage 1. Once the credit risk has increased significantly since initial recognition, it should be moved to stage 2 and banks are required to recognize lifetime ECL. It moves to stage 3 when the financial asset is credit impaired and banks will continue to recognize lifetime ECL and the incurred loss. How is IFRS 9 going to help banks to increase efficiency in order to reduce NPL? First, credit appraisal and pre-essential process of banks will be improved. Given the requirement of forward-looking expected credit losses, banks are about to tighten their credit appraisal process to reduce NPL. Next, banks will closely monitor their assets, which is the loans, to avoid them being classified to stage 2 or stage 3. These efforts will be initiated on a proactive basis in order to safeguard a bank's distributable profits, brand value, and keep the non-performing loans level under control. Other than that, IFRS 9 will enhance the transparency of financial reporting to the investors, public, and other stakeholders in terms of enhanced market disclosures.
The ethical dilemma related to the issue of non-performing loan is firstly loan scam. Banks suffer lack of funds to offer loans to potential borrowers when non-performing loan happen, so they offer loan scam to increase profits and to sustain in the banking industry. For example of loan scam is between 2010-2012, there was a loan scam perpetrated by the largest state-owned commercial bank of Bangladesh, Sonali Bank, where it illegally gave out 454 million in loans using scam documents. Secondly, provide untrue and unfair financial position. The problem with IAS 39 was that it defers the recognition of credit losses on non-performing loans until it is too late in the credit recycle. IAS 39 requires the bank to recognize its loan losses only if there is any evidence on the credit impairment. This allows the banks to not provide their true and fair view of their financial position. In order to make their bank appear healthy, they could overvalue their assets and approximately overvalue their profits.